Good morning, everybody. Welcome to episode 5 of Deal Makers series. So today we're focusing on the specialist residential sector. So here we're looking specifically at owner-occupied residential mortgages. This series has been really useful so far as we've seen many customers that are placeable through specialist finance routes, but either weren't pointed in that direction initially, or the case had some hiccups that we were able to resolve as a result of these webinars. And every one of these so far has resulted in deals being placed and therefore some excellent customer outcomes. So my challenge to all of you on the webinar today is to make this one the most successful one yet. So to do that, at the bottom of the screen, you've got the Q&A button. So please use that to submit any questions, queries, or scenarios that come to mind. And we will do our best to answer these during the course of today's session. And of course, any we don't get to, we will pick up offline with you afterwards. Now, the questions, of course, are only half of the equation. And to answer them, we need some industry specialists. And once again, we deliver in spades. Today, I'm delighted to be joined by our esteemed panel with over 60 years experience between them, not each. We've got James Briggs, Regional Account Manager from Together Money, Ryan Brailsford, Head of Sales from Pepper Money, and Crystal's very own Richard Bond, Compliance Director and Residential Expert. So thank you for joining us today, gents, and for lending your experience to our webinar guests today.
Thank you. Good morning.
So to start us off with then, James, we're seeing some crazy numbers in mortgage statistics for H1 of this year in the kind of volumes that are being transacted. Just how busy is the residential space currently and what kind of deals are you seeing funded?
Well, it's certainly exceeding our expectations together. In recent months, we've certainly been helped by the stamp duty incentives, and we'll continue to see those until the next step. But it's been a real mixed bag for us together so far this year. The beauty of our criteria is it is so wide and diverse, but we're seeing really strong support from our intermediary partners with self-employed cases, cases with unusual and challenging income, whether that be the level of income or the makeup of the income. I'm sure we'll talk more about that as the webinar goes through. You're always going to get clients for some credit difficulties in there, and no doubt we'll see more of those as COVID plays out. But in particular, in the purchase sector, we're seeing really strong demand in the shared ownership and right to buy space.
Okay. Very interesting. Thank you. Ryan, same one to you.
Yeah, I mean, relatively similar. I mean, we've certainly had a record-breaking first 6 months, and I think the whole market is saying that, haven't they? It's certainly the feedback we get from packages and brokers alike, which is fantastic. And we've seen a definite shift to purchase business, and that's naturally driven by the stamp duty holiday. So it was all a bit of a race to the end of June, and then I think everyone took a fortnight off, which was a nice little bit of relief. But for us, it's been, the sort of common customer. I mean, similar to James, obviously there's a good mix in there, but very common customer for us in the last 6 months has been the ones that might surprise some people, and it's not adverse related or maybe where you would have gone to a specialist lender in the past or thought to, but it's a lot nearer prime. So we're seeing the business that maybe would have fitted mainstream last year, that now the tightened credit scores or little changes in circumstances through COVID are putting them in a bit of a more complex situation. So self-employed are an obvious one, but not on their own in that. So yeah, changing circumstances, needed a bit more of an individual approach, and that's certainly kept us busy because we're geared up for that.
Okay. And Richard, what are you seeing from Crystal's viewpoint?
To be fair, it mirrors what both James and Ryan have said. Right to buy, shared ownership, 1 year's lots of figures, recent adverse in the last 12 months. Again, as Ryan's just touched on, also surprising, we're seeing more cases that probably historically would have been sort of classified as high street lending, but for one reason or other they're falling and filtering down to the specialist lenders like the guys that are online today and other ones we have on panel. So it is a real mixed bag, but definitely busy, and hopefully it will continue going into the second half of the year.
Excellent, thank you. So Ryan, I'll start with you with this one. So residential is obviously an area most brokers are comfortable with. So where are the big wins really in the specialist space that brokers should be looking out for?
Yeah, and I think it's actually quite sad to say because for the customers involved, but there's going to be more wins and more opportunities for brokers from now on, because as we come out of the pandemic, a lot more people have been affected in one way or another and are needing that specialist help. So I would say, it is not just thinking about adverse credit, but of course adverse credit is a big factor. If you're looking at things where they've got themselves in a little bit of a mess last year, You might not be wondering, whether you can place that or not. There are lenders like ourselves, speak to Crystal, make sure that you keep in touch really on those types of things, because you only need 6 months to pass, and we can help. But also definitely think on the wider side of just simply individual underwriting. Self-employed is a huge one for us, where their circumstances have changed during COVID. Maybe they've taken the government grants, things like that. So there's opportunities to really kind of get back in touch with your self-employed client base, and find out where they're at, because they've probably had to make some changes. They may have taken on additional income streams. Like I say, it's these kind of, they would have been mainstream, but now they're a bit more complex. I think it's where the opportunities are for brokers to really give good advice, and then help them with lenders that they wouldn't expect. From a mainstream lender point of view, we've seen a lot of operational restraints. They're struggling because they're very well geared up for high volume and high reliance on technology. So we're certainly sort of stepping into that gap really, because where they're trying to add a manual process that wasn't there before to maybe understand those types of deals a little bit more, we've seen them struggle, and it's not surprising. But we're, fully geared up and always have been to really delve into that on an individual basis, and it means we can help more people.
Okay, excellent. Thank you. James?
Yeah, I mean, the benefits around the specialist underwriting and the flexibility that affords with lenders like Together and Pepper through specialist intermediaries by you guys is kind of more important now than ever before, and having that experience and not relying on automated credit scoring. There's more and more clients falling into the specialist sector. And when we talk about the specialist sector, we're definitely not just talking about adverse credit, because that only makes up a small proportion of the business that we write it Together. It's all the other stuff that falls through the cracks of the high street, and those cracks are widening, as Ryan said. We're certainly seeing a lot around self-employed and self-employed clients coming out of COVID, and how we assess their income coming out of COVID, which is a real advantage to a lot of clients, and helping those clients and giving those applications a second chance when they fall out of bed with the high street. And we see a lot on non-traditional construction. A lot of clients purchasing property unaware that the properties are unacceptable to traditional lenders. So all of those types of specialist cases, more than happy to help with and assess individually. Also seeing probably as a result of COVID, the rise of the second residential in the UK. So clearly there's been a lot of demand for holiday let in the commercial space. But there's a lot of applicants purchasing second resi properties to use as solely holiday lets for their own family. So that's an interesting market and a growth market also.
Okay, very interesting. So Richard, having listened to those areas that lenders have the appetite for there, what contribution can you deliver which encourages the audience to have confidence in Crystal and your team?
I think obviously what we're used to dealing with is quirky and specialist deals. I mean, we get those on a daily basis. Obviously the guys upstairs got an array of knowledge and experience of dealing with these, but not only that, we have the relationships with the lenders. So obviously Ryan, James, numerous other lenders, we've got these direct contacts into the lender where we can sort of ask and sort of see where cases don't necessarily fit within the standard criteria as to where exceptions can be made and taken. Again, for ourselves, we're always looking to improve the customer journey and experience that our brokers receive. The ideal is that essentially they come to us with an inquiry and it's placed, and effectively it should be no different if you come to us with another inquiry of a similar thing. You get the same experience, and as I say, if it does fall out of bed with the original lender for whatever reason, we are there to pick it up, rehouse it, and again just pick the baton up and sort of move the case on. Ultimately, we understand the outcome for both obviously our broker partners and the clients. It's the most important thing, and obviously that's what we want to do. We want to deliver when we say we will. So from our point of view, it's sort of working together with both brokers and the lenders to get the outcome that everyone wants.
Excellent. I think picking up on a point that Ryan made there about the manual process, I think that's something that a lot of brokers miss out on as well, because the reliance solely on sourcing systems misses out a lot of the nuances of specialist residential. Because again, if you're just going on rate alone, there's a lot of things there that might mean that client doesn't qualify for that rate. I think when we're touching on rate, there isn't a huge difference, is there, from the specialist rates to the mainstream rates? If we've got kind of mainstream market over here and specialist there, there's now much more sitting in this middle section here that makes it now a much more viable option than it's ever been previously.
Definitely.
100%. I think obviously that some of the service levels that the specialist lenders offer actually are sometimes at the moment better than what the high street are offering. And obviously you add in the flexibility of the criteria that they can add. A lot of the lenders that we deal with, they're not system led. They're not like your Halifax, Santander, where it's a system says yes or no. As you've touched on, and the guys have touched on, it's an actual stuff that falls outside of the box can be looked at and a sensible sort of decision made on a case-by-case basis. So definitely.
Okay. So James, obviously residential is regulated, so there's a lot more rigidity around the criteria than there is in other areas, commercial, bridging, etc. Are there any key areas of flexibility with Together that the guys need to be aware of?
Yeah, absolutely. So I kind of categorize our flexibility into 3 areas. So the first one being income and the flexibility around what we can take for income. So I think we'll probably see a rise of applicants employed in the gig economy as an output of COVID, unfortunately. So we'll help those clients on shorter term contracts, fixed term contracts, and on 0-hour contracts. We're back to using 100% of bonus and overtime if it's paid monthly. And for those clients that have changed employment, we're happy to lend to customers in probationary periods as well, as long as there's a 12-month track record. There's lots of flexibility helping employed applicants. Then security is the next area. So non-standard construction types, things like flats above shops, clients operating businesses from home, maybe self-employed applicants that have moved away from commercial premises and now operating businesses from home. Those kind of non-standard type security makeups, pretty comfortable with those as well. Again, we'll see a rise in that, I'm sure. And status as well, so the flexibility around client status. As Ryan touched on earlier, there's a lot of prime clients out there that are just falling outside of high street criteria. So we've introduced a waterfall of products, from prime products with clients who've been clean from a credit point of view over the last 2 years, to some 1-year products, to some variable rate products as well. So it's catering for a wider spectrum of clients than Together have ever done before. And we've got 0 ERC, so ERC-free options in there on the variable products. So clients that have experienced some blips previously that just need to tidy themselves up before going back to the high street, we can accommodate those too.
Thank you. Ryan, same to yourself, the key areas of flexibility within the Pepper proposition?
Yeah, well, I'll avoid sort of repeating anything that James has said. So I'll just say same as him when it comes to, I think, some of the self-employed points he's just made. And it is, it's the flexibility of the specialist market, I think, that brokers really need to be aware of at this time, to be able to look at the detail, understand the story, ask the right questions. So I'll just add that and not repeat any other words. For me, I think the biggest thing for Pepper, our flexible approach is just simply the way that we lay out our actual product tiers from an adverse credit point of view. There's so many restrictions, not just mainstream, but even in specialist lenders where, from a CCJ or default point of view, it's, it can only be this big, or it needs to be cleared, or it needs to be this far away. And we don't score at all, so we don't kind of cascade. So it's not that sort of do a dip and find out what rate it is. And I think that's the biggest bit of flexibility that brokers and packages love from us, is that what you see is what you get. So there is no limit at all to values of defaults and CCJs. There is no need for them to be satisfied. And as long as they're 6 months old, this product, so it's really, really clear. And we can, we surprise people every day, I think, when they sort of say, I've got a 20 grand CCJ 7 months ago. I haven't paid a penny off it. Can you help us? And the answer is yeah. So that's probably our biggest flexible area.
Brilliant. Thank you. So Rich, following on from that then, can you give us an example of a strong piece of flexibility that you've seen so far this year?
Yeah, one of our lenders, basically we got an exception agreed where they were willing to accept sort of a future increase in the client's pay, base the lending on that future income. That was on the proviso that the loan didn't draw down before it completed. So effectively that enabled us to carry on processing the mortgage, get the legal side all sorted, and ultimately it meant that the client got what they wanted. It completed before the stamp duty deadline, and obviously overall the case wasn't held up. So yeah, it was a good all-round outcome for everyone involved.
Excellent. Yeah, that's a good example there as well, because projected income isn't something normally that lenders would look at, but with a good scenario around it, good plausibility around it, it was a really proactive decision from that lender to say, well, yes, we'll complete, but the first payment must be after the client's received the income so we can see it's there. So it shows the benefits of speaking to a packager that can understand and discuss these scenarios with lenders direct.
Definitely.
Excellent. So thank you for that. This is some good scene setting there on what we're going to be looking at today. So we've had some good questions coming in so far. So thank you to everyone that's popped a question in either in advance or on the Q&A. Please keep them coming. We will address as many of these as we can during the session. So the first one then, James, I think I'll start with you with this one. So Alex from Professional Mortgages has asked, how much appetite is there realistically for self-employed lenders post-COVID? Sorry, self-employed applicants post-COVID?
Mm-hmm. Well, I can only speak for Together, but it's a significant part of our business. I mean, a lot of politicians say that self-employed applicants are self-employed people are the backbone of the UK economy. And I think for the first time, we're over 15% of the workforce is now self-employed. Remains to be seen how those figures play out. I probably predict a bit of an increase in that as we play our way through COVID. But I think it's fair to say as well that the self-employed community have probably been some of the hardest hit by the challenges that we've been through the last 18 months. So to support that, we've built a number of criteria add-ons to help those clients and help packages get those cases away. Firstly, it's very common for clients to have taken bounce back loans and grants. We don't penalise self-employed clients at all that have utilised those facilities that have been available. And as Richard said, we utilise very successfully forecasted income. So I had an example of a case that offered last week, actually, a guy that owned a small garage. Unfortunately, had to let some of his technicians go during COVID, but he had strong 2019 figures, salary and divs of 85k, poor 2020 for obvious reasons, 47k, and the accountant had forecasted earnings back up to 77k year end 2021. His year end is a calendar year. So there's a clear rationale for us there from an underwriting perspective as to why there's been that drop. So clearly less people using motor vehicles in 2020. There was the extension on MOTs and less people using less cars, taking fewer journeys means less wear and tear. So there's a clear rationale. Client was successful previously at a level, had a natural drop due to COVID and is on the way back up. And I think that scenario will be mirrored across many people who are self-employed. So that's a key area of our support this year and next year, taking a sensible approach and looking at forecasted income.
Okay, thank you. Ryan?
Yeah, well, I agree with James that there's definitely a huge appetite from us to be able to help self-employed customers. I think, from a lending point of view, we just need to be realistic that we're asking the right questions. There's no point hiding that it's maybe more difficult to underwrite at the moment. And that's where, I suppose, my point earlier about some of the mainstream lenders struggling to do that, because it's almost like affordability's kind of got a different level at the moment. You've got to look at short-term affordability as well. And again, as James touched on, it's been very, very common for self-employed to take the help that's been available to them, and so they should. The underwriting standpoint now is working out, are they living off that lump sum and chipping away at it, in which case their income is not sustainable, or are they, of course, trading now again at the level that you'd want to see them trading? And that's the simple question that we're asking, and we're set up to be able to do that very easily. But as long as we can see that over the last 3 months they are trading at the level that we're using the figures for from the previous year, then we don't mind what help they've taken at all, because they were entitled to it and they were right to take it, because again, as James said, self-employed people have been hit the hardest, and they deserve that help to keep them going and to see them succeed now. I mean, an interesting case for us actually recently was a guy that was a tattooist. Obviously, he runs the tattoo parlour that was shut after everything else last year. But he's actually had, well, he's going to have, I think, he's had one of the best 6 months of his career so far, and he's probably going to have the best 2 or 3 years now, because during COVID and everything being closed, he actually appeared on that reality show about tattoos. I've completely forgotten the name of it, but I won't advertise Channel 4 programs on here anyway. But he was on, this particular program, and obviously everyone's watched him, and the exposure he's had, he's now booked up for the next 3 years. So his trading figures now are better than they've ever been. So it's having, the kind of individual approach to be able to understand that, rather than just say, well, there's your SA302 from 1920. And I think that's what we need to do in the specialist market, especially moving forward, is just really be able to ask the right questions, see a bit more detail, and then definitely support these people, because they will grow.
I look forward to seeing your tattoo, Ryan.
I know, yeah. I've completely bought into it. I'm going to go and get one now, yeah. I've got to wait 4 years, though. He's booked up. He's completely booked up.
Richard, anything further to add from that, from maybe the wider panel?
No, I agree. I think it's been a really tough market for the self-employed applicants. They've been penalised relatively heavy by the lenders, especially the high street. I think it's been a massive shift in terms of how lenders, high street lenders, especially sort of a view and the hoops, I guess, that they're made to jump through. I suppose rightly so, in view of the COVID sort of crisis we've had. But I think what that presents is a massive opportunity for the specialist lenders and specialist market, because essentially the high street lenders have probably come more aligned in terms of requirements and documents needed, as I say, in line with where the specialist lenders are. So I think, as I mentioned earlier and touched on the service proposition, the flexibility, I really do think some of the rates that they're not far off, and therefore it can be an attractive option for a broker and the client. And as I say, I think it's only going to sort of help improve the specialist market.
Excellent. I think we've also seen a switch in people's employment types. Maybe people that were employed pre-COVID maybe have taken self-employment on during that period. How do you stand on minimum time for self-employed applicants, Ryan?
So we're looking at 1 year's trading. So as long as they've got 1 year, and it is, I suppose, I'd add it's a true 1 year, because I know there are lenders out there that kind of will accept 1 year's trading, but then it's 2 or 3 years in the industry. It can be 1 year completely if you're doing something entirely different.
Okay, thank you. James?
So yeah, 1 year's trading, 1 year's experience in that sector, providing they've got an accountant. If they don't employ an accountant and they do their own books, then with 2 years.
Okay. So for people that did switch employment during that period, there's good options there for them to be able to take finance out now. Brilliant, thank you for that. We've got a couple of questions coming in live regarding property types. So we've had one. Has your appetite towards modular builds changed over the last 12 months or so as we try and improve the home shortage in the UK? James, do you want to start us off with that one?
Yeah, great. I mean, one ideal solution, I think, and a solution that's going to be more and more common as we tackle the shortage of homes in the UK. We've always been really flexible and pragmatic when it comes to those types of construction types. So together, as long as it's got a title, so we can identify it at land registry and the clients can access the property and we can get a value on it, then we will lend against it, albeit at a reduced loan to value. So on that type of property, we'd be looking at 60 to 65% loan to value, but no other restrictions.
Excellent, thank you. Ryan?
At this point, I would say we're not the place to go for kind of quirky properties. I suppose in answer to the question, is our attitude changing? Yes, I think it is. Nothing yet in terms of external changes to criteria, but conversations internally around it. But yeah, I think when it comes to those type of properties at the moment, James is your man, definitely.
Thank you. And Rich, anything, I suppose, wider than that on unusual property types or anything of that nature? Are you seeing a shift in lender appetite towards things that maybe they wouldn't be looking at previously?
A little bit. As I say, I think there's more lenders getting comfortable with sort of the non-standard builders, as kind of James touched on. I think it's still going to take a bit of time for it to become the norm, but we certainly have lenders on panel that will consider non-standard construction properties. So it's certainly worth sort of picking up the phone to us or dropping us an inquiry, and we can produce some terms for you.
Okay, excellent, thank you. And we're seeing obviously the rise of the green type mortgage as well, especially on the buy-to-let side, where lenders are looking at kind of innovative ways of amending their appetite and trying to encourage enhancements and improvements in the sector. So there are changes afoot. It's just going to be how quickly we can get to that. And I suppose that would depend on demand from borrowers as much as anything else. So following on from that one, then we had a pre-questioning regarding the valuer's comments and about the reliability on those, when it's clear that there's, I suppose the problem with specialist properties is that it does come down to opinion. If there are very few comparables to look at, then you are much more reliant on those valuers' opinions. Is there anything that you can add to that at all regarding confidence that brokers can have when they're sending in specialist property types, James?
Well, I'll start before we kind of address that. I'll start by saying that we made some significant changes to use of AVMs, so automated internet valuations, during COVID in response to valuer availability. So we're now doing 70% AVMs on residential purchases and remortgages. So that takes some of the valuer opinion away. So we're around 45% of all of our mortgages now go through on AVM, which is working perfectly, and we're looking to increase that and enhance that proposition. When it comes to valuers' comments specifically, it's the type of lender that we are and the type of market that we're in. It's not unusual for us to see those quirky properties, and it's fair to say that there are some valuers out there that will kind of sneer potentially at non-traditional construction types, unusual property makeups, those kind of things. That's where our experience and specialist underwriting comes in, with you guys as the first line of defence against that, and you guys, with your experience, asking the questions of the surveyor before the case even comes into us, and then presenting a more full opinion. But it's our experienced underwriters' job to cut through the opinion and understand exactly what our security is. So I personally, I'm less concerned about that. Okay.
And of course, the valuer makes comment about EWS1 forms or cladding or anything like that, then obviously any lender's going to take note of that, aren't they, and have to react accordingly.
Yeah, I mean, I think it's most, if not all, lenders need the appropriate protections or proof of the appropriate protections to be in place currently. That'll be something, legislation that needs to come down, and that needs to be addressed at a higher level than we can probably cover off today.
Yeah. So quirky properties are fine, but obviously they need the right protections and licenses and everything else in place from there. So hopefully
when it comes to cladding,
yeah. So hopefully that answers the question that came in previously on those. So thank you for that. So we've had a question through from Mohammed saying, if you can you talk us through your LTV limits, especially when it comes to adverse? Ryan, do you want to take this one?
Yeah, absolutely. So, well, I touched on briefly before about the way that we kind of tier our products. I'll give a little bit more information on that, I suppose. So there's this kind of 6 tiers, and we range them from what we call Pepper 6 up to Pepper 48. And where that kind of transparency comes in is that they're named after the amount of months that things like defaults and CTJs need to be registered. So it's just that registration date. So of course, Pepper 6 is your 6-monther and your most recent. Pepper 6 at the moment, you're looking at 75%. And then 12 and 18 are 80%. And then once you get to 24, so that's when your default CTJs are 2 years old and more, then you're up to 85. So nothing too low. I would hope that we can increase them again a little bit as we gain our comfort, I suppose, as the market comes back to normal now. We used to be at 80% on Pepper 6, and I hope to see it return. But yeah, 75 at the moment for literally 6 months, 80% once you're over a year, 85 once you're over 2 years.
Okay, thank you. James? He's still on mute.
Someone had to do it, didn't they?
Yeah, always one.
It's fairly straightforward, to be honest. So we have an LTV limit currently of 75% on purchases, 70% on refinance. The LTV doesn't reduce with the adverse but any adverse registered in the last 1 or 2 years, according to product type, would attract a slight rate loading.
Okay, excellent. So again, people think of specialist finance thinking 60-65%. See the guys on panel there are pointing out quite clearly that you can get a lot higher than that with so-called specialist cases. Brilliant, thank you for that. Hopefully that answers your question there, Mohammed. Thank you for that. Sarah from Knightsway has asked, what have you done to speed up processing times? James, we'll start with you.
Yeah, so we're really proud of our service. So we are at 24 hours to assess new packs in our personal finance division, which is great. So well-resourced, experienced team. It's fair to say the AVMs have really sped things up. So it's not uncommon to hear of 2, 3, 4. I've even had a 6-week delay yesterday on getting a value to a property somewhere in the Lakes, that was. So that has really helped speed up processing times. We've taken away some of the COVID type requirements that we had previously around declarations from employers about COVID and redundancy. We're more relaxed about that now as things get back to normal. And we've made some enhancements to our legal process, which really speeds things up as well. So specifically on remortgages and second charges, we have an in-house legal team that will take care of all of the conveyancing in-house, incorporated in our product fee. So the clients don't need to engage an external solicitor. We take care of all of that for them. Historically, that's where a lot of the time has been lost, particularly during COVID, with one solicitor communicating with another. If we can take that external solicitor out of the picture and handle everything in-house, we've seen some real quick turnarounds on those cases.
Brilliant, thank you. Ryan?
Yeah, well, service has been a huge thing for us actually over the past 12 months. And I suppose I'm quite proud to say we've never had bad timescales. So I don't think we've particularly improved them because we haven't had to. So we do move every stage of the process 24 hours, which is great. What we have done though, that obviously is sort of into the wider service piece, is that we've made it a lot easier to deal with us, I think, from a process point of view. We've done 2 things really. We've introduced an individual underwriter, so you get your own case owner from application to offer that looks at everything and that speaks to you directly. So, they'll pick the phone up to you when the application first arrives, they'll talk it through. If they've got any questions, whether it's, what's that on that bank statement or anything like that, that conversation is so valuable in comparison to emails going to and from between lender and broker. But on top of that, we've also invested in a new phone system, which has got lots of boring benefits that I won't tell you about that don't matter. But the main one is that you can actually call in, type your last few digits of the reference number of the case in and get through to that case owner. So not only have you got that individual named person that actually, exists and isn't hidden away in an ivory tower somewhere, but you've got a direct line to them. So that's made things a lot slicker, I think. And really, to Chris's point earlier, dealing with specialist lenders, packages should never be any different really than the kind of bells and whistles you're used to from maybe a bigger lender. The technology is there and we're just trying to make it as slick as it can be, because although the case seems difficult sometimes to the broker, it's our bread and butter and we do it every day. So yeah, service has been a big thing. Check out Trustpilot. It will tell the story rather than me.
Thank you. Rich, anything further to add to that? I think I saw at the start of, was it earlier this year, one of cases you were working on, was it 19 days for a lender to assess a document? Not one of these lenders, of course.
Yeah, no.
One of the prime lenders.
No, I think obviously we can't really influence the lenders' turnarounds. However, what we can do is make the broker's experience with ourselves a lot slicker and smoother. And as I mentioned earlier, it's something that we're always looking at trying to work on in terms of improving that journey for them. So obviously we launched our own hub, which is a submission sort of, if you like, tool for them to be able to submit inquiries. It takes literally a few minutes to be able to do that. It enables the broker to be able to book a specific appointment time with one of our underwriters to then take the case to the next level. The feedback we've had on that has been really positive. The uptake's been great. So again, if any of the brokers sort of watching haven't used that, really strongly recommend you go and have a look at sort of submitting a case through it and sort of seeing what you think. There will be further improvements and sort of enhancements made to it sort of in the coming months, but I genuinely think sort of we feel that has helped improve the broker's experience with ourselves. So.
Great, thank you. And I know one of the things we're hot on here at Crystal as well is what we call right first time, which is making sure that when we get a case into the lender, not only is it the right lender with the right product, but also the package is complete. We know what kind of documentation the underwriter will request, so we make sure it's all in there. And one of the big wins that we've seen there is really educating the broker early in that process that this is the information we need. And although it's specialist mortgages, it's from a documentation point of view, it's going to be very similar to what you'd be expecting on a standard. Proof of income, proof of residency, some bank statements, a couple of forms. So there's nothing really that should come as a surprise to the brokers that are sending in cases. So if, from a broker point of view, if you can help us get that information correct at the start, you're going to have a much smoother journey when that case gets to the underwriter. So it's a real team effort really to ensure that that case can move through very quickly.
Definitely.
So Joe in Bristol has asked a question about furlough income. So to the panelists, what's your view on furlough income appearing on payslips? Ryan, do you want to pick this one up first?
Yeah, no problem. Well, I mean, I suppose it's like we said about self-employed earlier. They've taken the grants, they were there, they were entitled to them, and it's the same for employed. We can't penalise somebody because they were furloughed. It's great that they're still in a job and that they're now back. So furlough appearing on payslips is not a problem, but we just need them to have returned to work. And naturally, we're looking for sustainability of their income, and if they are still furloughed, that's a bit riskier for us. But if it's very, very short term, for example, we've asked them for 3 months pay slips and they've been back at work 2 weeks, we can see that on the latest pay slip because it'll be a bit broken down. I think, worst case scenario, we might just confirm it with the employer to confirm that they're back and that it's not a half and half, flexi furlough agreement. But yeah, as long as they're back in work, there isn't a minimum time. They just need to be back in work, and we're more than happy to lend them as normal.
Okay, thank you. James?
Yeah, we're just looking for no furlough on the latest pay slip, and then we'll be comfortable with that. We cover off the any concerns the clients might have during our security call at the end of the process. And if it's a case where we're being asked to use overtime commission or bonus, that's where we'd need to see a little bit more of a track record. So we'd be looking for 3 pay slips. At a fairly consistent level, and then we could use the overtime and bonus as well.
Okay, thank you. Rich, anything to add to that one?
No, I think as you've just sort of seen, we've got lenders on panel that will do it. It's just their criteria varies slightly from lender to lender. So, it's certainly something that can that wouldn't kill a case.
Okay. I think that's one of the big points to make. Really, is that I think lender criteria is probably changed. I don't want to say daily, but it feels like it in some ways over the past 12 months. And, and that's the benefit of Crystal, really. They're close to us, they know it, they've got that expertise. That's just a big benefit to speaking to these guys, because you can't keep up with the amount of changes over the last 12 months, but they have. So yeah, keep in touch with them.
Brilliant, thank you for that. Again, it's something I touched on earlier about the sourcing systems. It's not just about putting it into your Mortgage Brains, 27 Techs, wherever you're using, and coming out with the best rate. It's about what does that client qualify for, and that's where the real good brokers can really add value to their clients when they know these scenarios. You don't end up going down 3 different dead ends with lenders because there's something in the background that people are not aware of. It's about getting that right first time, identifying that product, and really getting that nailed as quickly as possible.
Just to echo that, Chris, when we came back into the market post-COVID, we took the decision to go through packager only, so engaging with specialist firms such as Crystal. So a bit like the direct line slogan in car insurance, we don't appear on price comparison sites. We're not currently on the sourcing systems, so it's really important that brokers engage with specialist packagers to make sure that all bases are covered and that all solutions are found for clients.
I think that's a really good point to be making. So I've had a couple of questions that have come in live. I have a client who needs an interest-only mortgage. Can either of the panelists assist with that? James?
Yes. Yeah, so we can do interest only on our first charge residential proposition, and we can do it on second charges as well. Full loan to values available. The only thing we ask for is that the clients aren't using if they're capital raising, they're not using it for debt consolidation. It's not really what it's intended for. So we'll do a bit. We'll do a bit of light validation on the exit strategy, how they're going to pay the interest only off at the end of the term. Typically, that's downsizing, which is absolutely fine. There might be some kind of pension drawdown or other investment in the background. Really flexible about that, but yeah, full LTVs available. 70% remortgage, 75% purchase, interest only.
Thank you, Ryan.
Yeah, we're actually, I think, very good at it as well. So difference between us and Together, I suppose, is that we do restrict to 60% LTV. So bear that in mind. But then there's no other additional rules. So I think we see quite a lot of interest-only business, actually. It's probably one of our areas of growth over the past 12 months. And I think the reason for that is a lot of mainstream lenders will say, oh, yeah, we do it, but as long as you earn 100 grand a year, or, there's always different scenarios that I can't really relate in my mind to whether it's repayment or not. But yeah, so we're obviously exactly the same criteria as we always have. And I think the biggest growth area for us has been when they're that little bit older, because we'll end up to 75 years at the end of the term as standard, and we'll take earned income up to 75. And that's the same with interest only. So a lot of the cases we see in, it's like they're in their 60s now, and they want to just get a few more years out of the house before they downsize. Maybe when they had kids, they thought, oh, they'll be gone by then. But now the grandkids are around so often, they're like, oh, I can't move into a flat just yet. Or whether even they actually they want to stay put, but they want to do maybe equity release later on. But, they'll get better terms when they're 73 than when they're 63. So, yeah, we're definitely seeing sort of elder applicants. We calculate affordability on interest only. So the shorter term doesn't trip you up either, which is really good. And we don't have a minimum equity. So the downsizing just needs to literally be realistic. Can you buy a house in that area? I always joke, I'm from Bolton, I don't know if you can tell, but you can buy a street for 200 grand. So you certainly don't need, that kind of criteria to be able to downsize in that area. So yeah, we just ask for it to be a realistic figure.
Okay, thank you. Rich, anything further to add?
No, again, as you've seen, we've got lenders on panel that will do these quirky deals, and we've got additional lenders as well. So, as I say, it's just a case of completing a deal on the herb, picking the phone up, just get a deal into us. Let's provide you with some terms, and I'm sure we'll be able to find a solution for the client and the broker.
I will just add, Chris, we will do repayment terms up to 40 years as well. So there are options there for clients who ideally want repayment but are going down interest only for another reason. There's the option to stretch the term and make the capital and interest payment more affordable.
Okay, interesting. So that again, it comes down to the value that broker can add in the transaction. So rather than the client saying this is what I want, actually do some digging, do due diligence on it. Why do you want that? These are the options, and really find the right home for the client.
Yeah, I think that's really important, actually, James, because interest only is a great option to have, and it works for certain customers. But if you're taking it because it's a way of affording it when you're going to be told otherwise you can't, that's not a good start, is it?
Spot on, mate.
Yeah, we've been down that road before, haven't we? Yeah, brilliant. Thank you for that. We've had a question through: how do you view 0 hours contracts? Ryan, do you want to start us off with that one?
So we'll accept them. I suppose we kind of treat it similar to self-employed in the sense that there's no minimum. There's nothing to go off as a standard. So we prefer it if they've got 2 years experience, so we can look at a couple of P60s and get an average income basically. So yeah, 2 years experience and we're okay.
Thank you, James.
Yeah, we just look at the stability of how much they're earning. We are looking for 3 to 6 months minimum, 12 months continuous employment overall. If we can get a sensible average from the last 3 and it looks consistent and we feel it's in a sustainable industry, then we'll work from an average of the last 3, but ideally 6.
Okay. Perfect, thank you. So keep the questions coming through. We've got probably 10-15 minutes to go, so if you have got anything you want to get it in quickly, so we can give us the best chance of answering those there as well. There's a question here about right to buy. So James, I know you've got a right to buy product on the Together side. Would you do flats on the right to buy proposition?
Certainly, yeah, absolutely. So ex-council flats up to 4 stories we do at full LTV. So 75% LTV overall. when it comes to the high rise, we do drop the LTV down a little. So we'll be at 60 or 65, depending on the property type itself. Comfortable with deck access as well, which is something that a piece of criteria that knocks a lot of cases out with other specialist lenders. And a real strong USP of ours on shared ownership and right to buy is we'll fund 100% of the client's share. So a lot of clients have got the opportunity to be homeowners for the first time, but don't have the 10% deposit to put through. As long as we're no more than our overall LTV exposure, we'll fund all of that purchase price for the clients, which is a fantastic piece of criteria that gets used a lot.
Brilliant.
Yeah, definitely.
Yeah, sorry.
I was just going to say, obviously, just one thing to bear in mind with the right to buy is obviously to get the Section 125 full document, for instance, into us, because there are sometimes some calculations that need to be looked at, which can impact affordability. But as I say, as James mentioned, 100% of the purchase price based on the LTV. So it's a really good USP there.
Perfect. Anything to add on that one, Ryan?
No right to buy from us at the moment, so I'll duck out of that question.
So thank you for that, and thank you for the question coming through as well. Another question that's just arrived on here. I'm struggling with a client with a couple of very recent late credit card payments. Is that something that the panel could consider? Ryan, we'll start you off with that one.
I'll take that one. Yeah, I mean, we're great for that. So I suppose, as I explained before, we don't credit score and we have the sort of transparent product tiers. The only things that will ever move you off the top tier and the cheapest rate is the registration data default, CCJs, or secured mispayments. So unsecured never comes into it. So credit card payments, for example, you could be 2 or 3 months down now, and we would actually lend to you. Or we'd say at application is bring it up to date, because if you don't, it could default, and that makes it a bit of a different case at that point. But yeah, it simply won't affect you. There's no criteria around it, and there's no scoring issue around it. So you'd be on the cheapest rate we offer, even if you were 2 or 3 months in arrears.
Okay. Thank you, James.
Yeah, similar. We don't score any of our products on commercial or personal finance. It's all manually underwritten. The thing we'd just be looking out for on that case with very recent declining profile is there going to be an ongoing issue with the client with affordability? And that depends what the case looks like. So if you're doing, for instance, a second charge or a capital raise and remortgage to consolidate, and we're going to put the client into a better position and it's a blip, then we'd be really comfortable with that, subject to the rest of the case being okay. Where I'd be a little bit cautious if it was a purchase and they were a first-time buyer and they're falling behind on unsecured payments currently, and we're adding to their indebtedness, particularly if they're moving, first-time buyer moving from parents into a purchase. But we don't tend to see too many of those cases because we operate through specialist packages like you guys, and you ask those questions up front. But on the face of it, for the right kind of deal, we wouldn't have any issues with that, and we certainly have no kind of arbitrary criteria around unsecured arrears.
Okay, excellent. Thank you, Rich. Anything further to add to that one?
No. As I say, we've got Pepper that will do that. We've got a couple of other lenders, but Pepper would be pretty much up there in terms of competitiveness on rate.
Okay. Excellent. So we've got a question from Catherine from Your Mortgage, who said that she does a large number of prime mortgages, but hasn't really got into the specialist space as of yet. What are the key USPs for you as a lender that you should be aware of? James, do you want to start us off?
Yeah, well, interest only is a big one for us. So, a lot of high earning clients with annual bonuses really take advantage of that proposition that's there. You'll have a lot of credit-worthy clients who can comfortably afford repayments but fall outside of LTI criteria with other lenders, specialist lenders or the high street. We have a real-world affordability calculation based on their individual income and expenditure. So we don't have any LTI caps at all. So that really helps. Self-employed forecasting income, 40-year loan terms, gifted equity to 65%, gifted equity to 65% LTV, gifted deposit to 75%, and those variable rate options as well with no early repayment charges, no tie-ins. So really useful.
Okay, brilliant. Thank you, Ryan.
I think we've probably already stolen our own answers to this particular question because, yeah, I mean, interest only would have been an obvious one for me. That's something that we don't tend to see adverse on. We do quite a lot of cases. They're clean, but it's that criteria that they're coming to us for. I suppose what I would say is, you don't deal with a lot of adverse. You see a lot of prime customers. Just, bear in mind what sort of near prime looks like, and it doesn't always mean that there's something physically on their credit file. It could even be down to a first-time buyer with a lack of credit. They've done all the right things. They've saved their own deposit. They've done everything that they thought was right, and then because they haven't borrowed any money, they're suddenly being penalised for it. We see quite a lot of that, and they are arguably clean. So definitely use us for those. And then on the flip side of it, it's your over-indebtedness. And we see that quite a lot in two situations, really. One, to say COVID again. I promised myself I wouldn't talk about COVID as much today, actually. But if we use the last 12 months as an example, a lot of people have sort of borrowed their way through the pandemic a little bit. Maybe their overtime's gone down. They haven't lost their job. It's not been that severe. But their costs have gone up because they're at home all the time and their income's gone down because they're not working as much. And you see people kind of borrowing their way through it, and they've not missed any payments, but now they're over indebted. Now we don't have a debt to income ratio, so we're very good at that. And that's whether you're leaving it in the background, but you're hoping that no one will kind of, hold it against you. But also if you're looking at doing debt consolidation, which we're also very good at, and with no debt to income ratio, it fits. But also, I mean, COVID aside, one thing that we've seen for a few years now when it comes to sort of over indebtedness, it is younger people usually cruising about in a brand new Audi that costs the same as they earn in a year. And the whole PCP kind of way that we're all living now, they can easily afford the £250 a month, but they don't realise that they actually owe 25 grand. And that can trip them up on the high street as well, because the lender's going, well, you earn 25 grand and this loan's the same. We don't like that, you owe too much money. So yeah, even perfectly clean customers, they're the ones that we tend to see where we're just a bit more flexible with them.
Brilliant. So we've touched on the last 12 months. Obviously, it's a very pertinent topic at the moment. So I'm just going to ask you to take your crystal ball out for a second then. So where do you see the specialist market going over the next 12 months? So James, do you want to start us off?
Well, we have some significant targets that we need to hit over the next 12 months. So I'm sure the specialist market is going to continue to grow and grow. I think what is a special? It's very hard to define what a specialist case is in the current environment, because you don't have the when I joined the industry in the 90s, you had very definite prime business, mid-prime, subprime business, and the divides between the prime and near prime are definitely not there. And what one lender defines as a prime case, another will define as specialist. But I think we just need to continue to innovate our proposition, work on our technology, work hard with our partners to spread the message and educate the options that are out there. And I have no doubt that it will continue to go from strength to strength, particularly if you look at the high street and look at the number of high street branches that are closing at the moment. More and more clients are engaging mortgage advisors, mortgage brokers, so more options are available to them, and their eyes are being open to the specialist options that are out there. So I'm really, really optimistic about the market over the next 12, 18 months, particularly when it comes to working with professional firms like you guys. So thank you for your support.
Thank you. Ryan?
I completely echo James's sentiment. I think it will definitely grow. I think it will grow for probably two reasons. One is that sadly, adverse credit and that side of things does continue to grow, and there's just a need. But also, I think the education side of it is really, really important, and we're getting there. I think we're building a bit of momentum, but we can probably do more as a collective, from specialist distributors to intermediaries to obviously all of the specialist lenders, because we're really proud to be intermediary only, but the drawback of that is that we're not advertising to Joe Public. And I do think that there's a lot of misconception in the public that they can't be helped. So whilst, as James touched on, I think more and more people are going to brokers. That's great. but they are the ones that have actually taken that step. There's also a lot of people chatting to Frank down the pub who's telling them that, oh, no, you won't get a mortgage if you've got that. Forget it. Don't even bother trying. And then the phone doesn't ring, and there's only so much a broker can do. So I do think, we need to make that phone ring a little bit more, get them in front of the specialists to get that good advice, and then to come to lenders like us who can help them. So I think it will grow, hopefully, over the coming years through further education, further awareness of where we can step in and help people in more complex scenarios.
Thank you. Richard, where do you see things headed?
As kind of again to echo what those guys have said, I think I touched on it as well a bit earlier. I think the gap between the specialist lenders and the high street is narrowing. I think there's more brokers that are coming over to the specialist lenders and are using the likes of Pepper and Together, obviously through in terms of the clients that they're seeing, that the client scenarios are changing. But yeah, I think the key thing for me is sort of the innovation from the specialist lenders. Obviously the AVMs, they a lot of them sort of took that over the COVID period. I think the tech's improving. So I think the more the lenders, specialist lenders and the standard lenders sort of become aligned, I just see the market growing from that side.
Brilliant, thank you. So really good questions that have come in there. So thank you, everyone. Hopefully you've got some answers and can go away from this now with a bit more information on what the guys can offer. So to finish off then, the question that we like to end with at all times is, can you give us an example of your favourite deal to fund this year so far? So Ryan, start you off.
Yeah, I think for me, it's when you get an opportunity to see the impact you have on the end customer. I mean, I literally just touched on the fact that, we're intermediary only. There's a lot of people kind of in between us and what's really going on, I suppose, sometimes. And it can be easy to think about a reference number or a house purchase rather than somebody's home and somebody's life. One that sticks out to me recently was a letter that we received from a lady who we've recently completed with. She'd been to a lender before us and had all sorts of trouble. I think she described it as an absolute nightmare in her words. But I think, the timescale was a big issue, and she really opened up about the impact that we'd had on her life and the struggles that she'd actually been having in them, and it really was eye-opening. So she was actually trying to do this house purchase to leave a partner who was abusive. It was a domestic violence situation, so it just really hits you. How much she needed to buy this home. It wasn't a house purchase; it was a new life for her and her children. And we've obviously managed to do it, which is fantastic, and and she's in that home now. But she was talking about sort of dealing with us directly. She'd been calling in nearly every day, and in her words, she said, she was kind of riddled with anxiety and just wanted to always check up on it. And the case owner who was looking after it had spoken to her every single day and sort of talked her down and calmed her down and promised, this is where we're at, this is what's happening. And when it went to offer, she wrote us this lovely letter. She described the underwriter as an angel. And in fact, she took to Trustpilot. I don't want to throw that in twice, but she did take to it, so you can find it on the second page. But yeah, that really, I think that'll stay with me. It will really, really stay with me, because it's too easy to not see the things like that go on in the background, and the impact that we have as a lender just in doing the loan, but also those little bits where every member of staff has been involved and had conversations with her that have just made her feel better along the way. So that's really important.
Yeah, excellent example. I think that's a really good point as well. The fact that to all of us at times it's an application, it's a case, it's something that we need to complete. But to the actual end customer, as you say, this is their life, isn't it? We don't know what else is linked to that in the background. Be it children, downsizing, upsizing to help grandchildren start a new business, whatever it's going to be. There's a reason for that move, and it's really important that we all stay in touch with that. And at the end of every transaction, there is a customer. And that experience and that journey that customer receives needs to be the best it can possibly be. And that's really useful on there, Ryan. Thank you. James?
Yeah, guys, 100% agree. I mean, the most satisfying ones are where you see the difference that it makes to people's lives. I had a broker contact that I've known for several years in Yorkshire, who was looking after financial services for the whole family. And the uncle had a buy-to-let and he lost a tenant during COVID. And what he did is he gifted equity, so his niece, who was disabled, could move into the property. So he gifted 40% of the property value as a deposit. Her income was made up entirely of benefits. So it's ticking a couple of boxes of our USPs here, genuine case. The broker didn't have direct access to Together, as we're specialist packager only. So it's one that I referred into Richard's team. And the guys at Crystal got it completed in, I think, 6 weeks. The client had been saving for years, never thought she'd be able to move out, be a homeowner. Combination of great work by you guys and fortunate circumstances and being gifted that equity meant she realised her dream of being a homeowner, and everyone was really delighted with the outcome.
Excellent. Yeah, it's nice to see the success stories from start to finish there as well. Brilliant. Yeah. Rich?
Yeah, I mean, the one that stands out in my mind was it's only a small loan, to be honest. It's a £50,000 loan, but it was complicated with it going lending into retirement. So it meant that the future affordability was being calculated based on various pension pots and income that isn't sort of your standard payslip or account. So it's very frustrating because of the multiple pensions. The lender's underwriter couldn't really kind of get to grips as to where the income was going or what income to effectively use to assess affordability. So, absolute sort of where we added the value was one of the loan managers sat down, broke the income out from all these pension pots, broke it down into a spreadsheet, working on a worst case scenario of the minimum income that client was going to receive. And we presented it back to the lender's underwriter, who at that particular point was sort of got a full understanding. Then they could see that they effectively made them at ease with the case, and that enabled it to proceed. It went on to complete, and obviously both the broker and the client were over the moon. So it was great teamwork from all parties. So and it got the end result that we all wanted.
Yeah, excellent. Yeah, I remember that case well. The clients had been renting there for 20 years, and the landlord wanted to sell the property, so gave the clients a notice to depart. And the clients were like, well, no, we've lived here for 20 years. We really want to buy this property. What can we do? They went to the broker out of the blue, not even saving for a deposit or anything like that. Just, well, what can we do? How can we buy this property? And it was just hurdle after hurdle after hurdle with income, deposit and things like that. But the strength of Richard's team there going through those, I think there were 8 different pension pots, NHS pensions from different years and different schemes that were all there. So it took every ounce of brain power to work out exactly what was going to be there. But again, the proactive underwriter at the lender honestly came back and said, prove to me where the income is and we'll take a view on the deal. But at the moment, it could be anywhere within these documents. So it was a real nice case to see that go through. And again, the client rang up afterwards thanking everyone. I thought I'd be homeless in 6 months kind of thing, and you've managed to get this done for me. So it's really nice when we can see start to finish that whole journey go through and realize that these things aren't just applications and numbers, they are people's and people's homes. Brilliant. So we've run a little bit over there, but I think that was definitely worthwhile with those, especially with those stories at the end as well. So thank you, first of all, to the panel, James, Ryan, Rich, thank you for your time this morning. Some excellent things that have come out there, and hopefully the brokers that have tuned in have now got some more information about how you guys can help. So thank you for that.
Thanks for having us.
No,
thank you.
No, it's been a pleasure. And thank you to everyone that's attended. There's quite a number of you still on at the moment. So hopefully there's been some good information in there for you as well. If you do need any further information, all of our contact details are provided. If you do need to speak to James or Ryan about any cases, please feel free to give us a call. We'll happily put you in touch and get these moving forward. So again, from me, thank you very much. Stay safe, stay busy, and we'll see you all soon on the next one. Thanks all.
Okay, well,
Thank you.
bye-bye.
Cheers.